Good morning, everybody. It's Tuesday, July 9th, and this is the AgYield War Room. I'm Dan Dempsey, and I'll be moderating today's session. As always, if you've got any questions or comments, please feel free to drop us a line in the chat area, and we'll be sure to get to it during the show. Overnight markets here, December corn up a penny and a quarter at 409. November soybeans were down 3 1/4 at 1096 1/4. And December Chicago wheat was up 3 3/4 at 598 1/4. Yesterday, after the close, we had crop conditions. Corn rated 68% in the good to excellent category. That was up 1% from the previous week. Beans, same number, 68% good to excellent. That was also up 1%. Winter wheat harvest moving along pretty steadily here, 63%. That was up versus 54% a week ago and 52% for the average. And the spring wheat crop made some significant progress, up 3% in the good to excellent category at 75% good to excellent. That was versus 72% from the previous week. Good morning, guys. Hope everybody's doing good. Dustin, I thought maybe this morning we talked about it towards the end of yesterday's show in terms of the new commitment of traders, talk about fund position and a couple of those key items that seem to be on the forefront of our minds this morning. One thing to note that in addition to that report, corn open interest was significantly higher yesterday, up 18,706. So maybe a few thoughts on that to get us started, and we'll throw it around the room.
Yeah, thanks, Dan. Yeah, a lot of times when you see someone estimate what the funds are doing over the week, it usually corresponds with the direction of the market that week. So there's a reason for that. A lot of times you see, larger moves, and then you take a look at that COT report at the end of the week. This week it was on Monday. And then it kind of confirms that bias that it was, larger contractual selling by managed money funds that was driving the move. So we got this report, yesterday afternoon. It showed funds that are very near record short when you do futures and options combined. They're, I think, just within 5,000 contracts of where they were back in Feb of 2024 for that. That was the prior record short for the combined number. But yeah, we know that probably is going to grow just based on market action going into this. We had, new lows that have been made, and they count those actually as of Tuesday. So as of today, we'll get that report on Friday, see where they actually are. They're always kind of in the rears, which doesn't help because, by the time you get to the next report, they change quite a bit. But why is it important? It's important because they're a main driver in the market. They've forward sold. Justin said something I think is true, is that they're kind of banking on the fact that we're going to have a lot of bushels that are still sold from old crop, especially in the month of August, that are on DP that can't be rolled past the September contract. Those are going to get marketed at the same time that we're kind of coming into, kernel counts of our new crop, and those bushels are going to be sold too. So you've got two crop years that still have a lot of selling pressure to come, and they're getting record short ahead of that. So our guess is they'd probably use that time period to exit the position. That they're really at the size that they are. They need someone to take the position off their hands eventually. Now, something comes up, a catalyst, crude oil spikes above $100, or, something that we just are unaware of today. It's, lurking below the market duratio. It's a vulnerable position for the market because it's such a big record short. That is something to note. But it doesn't mean they have to get out if that catalyst never comes. They have a carry market. That short position is a very easy one to stay with for a long period of time. And we've seen that with contracts like SRW. They've been short for years in some cases in those markets because they have the carry in their advantage.
Yeah, I do think what's interesting is, talking about, usually when they have these big carry markets, it's kind of like, getting paid a dividend to stay short. And what's kind of interesting here is that while we do have decent carries or even good carries in new crop, the old crop contracts are inverted, and we supposedly have record amount of on-farm stocks, both corn and beans. July Nove beans traded, 80 cents over inverse overnight. I know we're in deliveries, but we saw some oil deliveries. Really haven't seen any meaningful deliveries. Corn, July SEP corn traded 8 over. Again, I know it's thin and it's a commercial market, but the funds are pressing flat price into, an area where spreads might start to narrow. We've seen bases come up. I think there's a lot of reasons for that, right? We talked about it before the show, but you're coming into all these support levels with crop insurance and government payments, where the risk reward of, missing out on the downside is getting smaller by the day, to the point where, if you're looking at, 95% policies or premium policies, they're already deep in the money, especially on corn. It doesn't mean that the market can't continue to go lower, obviously. But as that incentive, as you hurt less and less people by having these products on, it skews the risk reward back towards the longs, in my opinion, as you get deeper in, sub $4, $3.50 corn to be the best case scenario for a lot of growers. And we've talked about this a lot of years in the past. And sometimes you get down there because there's just enough forced selling that has to happen. But it kind of creates a rubber band effect because you've created too much money in a low price environment, where the market likes to kind of deviate back towards, equal pain, if you will, for buyers and sellers.
Yeah, and I just want to add to that. Like, I had a question this morning. So you guys aren't in the camp that it's going to go to 310 or 315. Like, a lot of chartists are talking about that because that was the COVID low, and a couple of reasons why. Obviously it could go anywhere, but just what would happen if it did? It would be a windfall for a lot of types of growers, because you would spur a bunch of demand. Basis would not have a problem more than likely at that point. And you would have a lot of coverage. I mean, 85% policyholders, if they grow their APH exactly, that payment starts at $396. If you have your county hit its county projected average exactly, your marketing your average starts paying on our county somewhere around $417. So if you trip both of those payments, now all of a sudden you're getting two forms of payments the lower you go, and it ends up being a windfall for that particular season. Now you still have 2025 to consider if that were to happen, because that would certainly be going lower too. But, there is a cost of production issue, I think, that's not matching. And we've talked about this a lot on the show, 540, 530 break evens at your average APH. We're seeing that everywhere. We're seeing that in the university data as well. It costs us more to grow the crop than what we've had for a selling price opportunity through this entire calendar year. So, what brings that cost of production down? Pain, right? Lower prices for an extended period of time. It takes a while for that to happen. So in a way, a $3 corn environment helps people if you can trigger double payments and get the next year's cost down, and spur up a bunch of demand in the process. Maybe disincentivize some of the production down South America if you can. I know that's very hard to do. So that's part of the reason why I think it's going to be hard for it to go down there, because the market sniffs that out a lot of times. The other reason I think it might be kind of hard to go down there is just flat out purchasing power. Even though the dollar index is strong relative to other currencies are weak relative to themselves. Purchasing power around the globe has gone down, especially post-COVID. So we've lost, last time we were around this level in, 2019, when we had that spike, we've lost 25% of our purchasing power of the dollar. So look at other things like crude oil, gold, value of land, value of retail properties. Everything costs more. So to say that your one bushel of corn should go back down to that same nominal number that we were back then, when we know that's kind of been the floor since 2008, $3 corn, I think we need to kind of readjust our expectations based on the purchasing power of the dollar too.
Yeah, and to devil's advocate, like, all those things do matter. And I think the key too is, like, in the short run, it can do anything. If they want to go sell another 150,000 contracts of corn, it's going to go lower. But I think, to your point, like, if you look at all these bigger picture things, like the unintended consequences of that, besides just saying, hey, it matched a chart from 10 years ago, is that there's a lot of things that you got to consider on, how that affects the farm. And I think at this point, we're most growers are pollinating or past pollination or just starting right around there. You really got to figure out where you're at on your yields, because that's where your floor is, based on crop insurance and how you trade and how you cover hedges. If you get into areas where, you talked about double payment just from government payments, but a lot of people have good hedges on too, or put options or other things, like you start getting triple paid. And then the what hurts you is a 30 or 40 cent rally. You lose money on that rally. And that's where we've seen a lot of people kind of mismanage around crop insurance. And it's one of the most important times of year to really kind of figure that out when you start getting into those payments.
Yeah, that was a huge thing in COVID. Obviously the world was ending at that point in time. We're at 320 corn, and a lot of the discussion at the time was, well, we can go to 280 just because there's no demand and everything's shutting down. And it was that there was a bigger risk of a move back up to 4 than, going down to 280 because of those triple payments, like you said. And, trying to prevent too much selling, prevent that, because you end up, if it did go back to 4, well, you got a bunch of sales at 330 now, and you didn't get farm bill payments, and you didn't get any crop insurance payments, right? That's a big kick in the face. Well, that's exactly what happened for a lot of people in COVID, right? It was a panic, and ultimately we found the demand from China, and we found that the duratio did impact yields bigger than we expected, and the market went way past 4. It went, it was into a bull market. So,
well, and that's how you get those big moves, because we actually went from like triple long to double short in a quick amount of time with accumulators.
Yeah.
So we went from people getting double, triple paid to getting double short. So that's what can happen when you get these big positions, these big moves. Like it can whiplash pretty quick when it gets out of balance.
Well, and I think we saw that too recently in the wheat market, right? You got a big short lined up getting ready for harvest in the US, and then you have a fairly significant problem globally. And it was a get me out trade 4 weeks before they started the harvest wheat. Now, granted, that one's definitely skewed from an open interest standpoint, but I think the short as a percentage of open interest in corn is a record right now. So it doesn't take a lot when people put on these big trades if something is to materially change, whatever that may be. And it could be currencies. We had discussion last night a little bit about, what does a macro event look like? We've had this great run. We were heading to an election. Like, there's a lot of things that can turn people into a risk-off mentality, and being set up for it. And I think this is a really good time to talk with your advisor and look at what contingency planning looks like in the event we do have this big cratering market and we are down at really deflated prices, on how to address that for your own personal needs based on where your yields are at, what your hedges are, in being able to capture that government payment. Because in 14 we saw that happen, and we did nothing but rally the month of October, and it took people out of payment. So it's a really good time to go over what contingency planning looks like, 50 to 70 cents lower, 50 to 70 cents higher, and wrap your head around how you want to address either of those moves.
And we've talked a lot about corn here this morning, guys. Justin, real quick, I mean, the soybean market, it's still staring at zero new crop purchases from China. You've got obviously the hurricane, the water coming up through the middle of the Midwest here, and we still got to get through August, but it's like, seems like $11 beans right now are kind of interesting,
Yeah, I mean, look, obviously we know that August is what matters for beans. So it's too hard to put the crop away this early. So it makes sense that corn's the leader right now. At the same time, I still argue that beans probably have worse fundamentals. If you're a $3 corn bear, you probably should be a $9 bean bear, in my opinion, or $8. If we finish out August with really good rains, we're going to have too much of both crops, right? So that's the long-term problem if we finish off really good. That being said, we're just getting to pollination. You have so much time. You still got to, fill out the kernels on the corn, and, you can definitely take out, some kind of a disaster. Obviously, we've had enough rain to this point. We're going to have probably a good crop, but it could be quite a bit different than what we're trading today. And beans is really hard, right? Because you can make, I've seen record crops made in August and disasters made in August, no matter what July looked like. So I think it's kind of justified to be kind of a laggard to corn on the downside here. Same thing as you got, July Nove 80 cents inverted. You've got $2 crush margins. kind of tough to really press beans on July 9th. But, the problem is if you talk about just market structure, is that we're much further away from those government type payments. We're much farther away from that crop insurance. So that's the structural difference between corn and beans. Fundamentally, it makes sense why they might be a little laggard, but structurally, beans are have way more risk to the downside to a farmer than corn at these levels.
Okay. Just coming into the open here, Ryland, a few thoughts on the livestock, I know we're seeing an increase in open interest in cattle, which is kind of counter seasonal to what we usually see. So maybe a few thoughts there.
Yeah, I think the run up has kind of inspired everybody. We keep seeing cash higher. We keep seeing beef prices higher. I mean, it's trading a little bit on the contra-seasonal side. So, there's definitely some concerns, especially yesterday. Like, this is the second kind of abrupt sell-off we've seen. I mean, I know the rolls kind of started here in the livestock. So overall, it's just, there's a lot of concern that this thing could turn at any moment, right? Just because we're getting into that time period. So you've seen a little bit more concern, I think, just because beef prices are starting to, even though choice is up, you had a little bit of a down in select overnight, and we really just haven't seen anything as far as cash goes. Show lists are bigger in the south and the north this week, so I think everybody's kind of looking at it like, hey, another round of steady cash, maybe even lower, from here on out. So we'll see how it goes. There's a big discount price on the board, so we've already anticipated market starting to come down here a little bit. So we'll see if there's any kind of move towards that. But right now it looks like the funds are pretty comfortable moving from August and October in both places. We did see open interest come down a little bit. So it does look like there was a slight amount of liquidation here as we start to look forward out. So it just kind of feels like once we get past this big seasonal demand time frame, there could be a lot of air pockets down here if the thing decides to go lower. So I think it's just kind of a cautionary tale. As the story is still kind of bullish on the cattle front. It's why the managed money is still holding 63,000 longs at this point, added 7,500 the previous week. So there's been a good story lately. It's just, we need to see that continue. We need to see the beef hold up. We need to see the meat hold up and the cash hold up. But right now, they're just, maybe you got a little bit of concern from the hurricane that was making landfall as well from yesterday's action. But hopefully, we can kind of slow things down a little bit today and just wait to see if there's any kind of indications from cash.
Very good. Appreciate the update. Just came into the open here in the grain markets. December corn now up 3 at 410 3/4. November soybeans are down 3 1/4, 1096 1/4. And December Chicago wheat is up 5 1/4, 599 3/4. Every day that the markets are open, we're streaming live on X, Facebook Live, and YouTube Live, 8:15 Central Time. Appreciate all the thoughts and comments here this morning, guys. It was a good conversation. Hope everybody has a great day. We look forward to talking to you again tomorrow morning.
Thanks, Dan.